Hi guys, good afternoon. There are people still coming online. Give me a minute to get them on board. All right. Can you all hear me?
Yes, we can hear.
Super. Okay. All right. So last week we kicked off on an introduction. Right. We discussed. We did a basic introduction to corporate finance and treasury. So for the benefit of those of you who missed, we discussed what the 3 units of a treasury. What are the 3 units, if you all can remember? So all of you are new this week, is it? No one was there last week? You can unmute and answer. Front, middle, and back office. Very good. Right, so there's front, middle, and back office. What is the role of front office? All transactions originate at front office. Then the risk is monitored at middle office, and back office executes transactions. They keep accounts and maintain records. And so these are the roles of the 3 units. Then we covered a little bit on rogue traders. We studied about 4 traders who ended up being rogue traders. Who are the 4? The 4 rogue traders that we did last week, along with the banks that they worked for. Yeah, who was at Barings Bank? Nick Leeson was at Barings Bank. Very good. And what is the movie based on Nick Leeson?
Rogue Trader.
Rogue Trader. How many of you all watched it last week? Excellent.
Watched.
Very good. Did you all find it interesting, or you fell asleep? Did it put you to sleep? Okay, wonderful, right? Excellent. Okay. Right. So Barings Bank, Nick Leeson. Who are the other 3? Jerome Coeville at which bank? Society General. Then we had Kweku Adeboli, who was at UBS, and Bruno Excel at JP Morgan, right? Those are the 4 traders, the 4 rogue traders. And recently we had Tom Hayes, who was a Citibank trader. Now this guy did something very interesting. He was not a rogue trader, but he manipulated markets. He manipulated the LIBOR. You know what LIBOR is? The London Interbank Offered Rate. So almost the entire world prices their assets and liabilities on LIBOR. Right? And this guy, just one guy, manipulated LIBOR to his advantage. And he didn't do it alone. He spoke to traders of the industry in other banks, and together they started manipulating LIBOR, right? Which was a a daylight robbery, actually. Right. Well, Tom Hayes was he was penalized. Interesting case study. Go through Tom Hayes also. I'll type his name for you all. Because I want you to read about Tom Hayes. That is your homework for this week. Any questions from last week? Anyone who missed last week? Who weren't here last week?
I missed last week lesson, sir.
You missed. What is your name?
Melvis.
Okay, right. Okay. So we have one newcomer. Anyone else? Melvis, I think you can listen to it online. I'm not 100% sure. You need to check. So what you and the others who missed it, who may have missed it, or anyone else who wants to refresh your memories, what you should do is go back and listen to what we covered last week. Right? It's very important that you have the fundamentals in place. Raj Rajaratnam, he was running a fund called Galleon, which was also into, if I remember right, money laundering, right? Okay, Tarendra, you have said that you watched Nick Gleason but couldn't understand the way derivatives work. Okay, that's fine. That's fine. For as long as you... Now, what you should do is, we will be covering derivatives later on, towards the end of this course. Derivatives is very simple. You will wonder why people think it is so complicated. It is actually very simple. So what you should do is now, derivatives will be a little easy for you because you have watched this movie, right? So after we cover derivatives, you can watch this again. Then you will understand what really went on there. Yeah. For now, it would suffice if you understood that it is a product which can be traded. Right? What he did in the end was something called a straddle. He went short straddles. Right? So we'll be covering straddles very briefly, and then you'll be able to understand better. Right. So this was literally daylight robbery. Right. Any more questions from last week? No questions. Okay, so let's move on. Okay, right, we are good to go. Now, how many of you, by the way, can you all see the slides, the set of slides that is on screen? Or are we on a wrong page? Can you all see the slides? Are the slides visible?
Yes, sir.
Okay, great, thanks. Okay, so anyone who has invested in equity? Have any of you invested in equity? Has anyone invested in equity? No one. How many of you have never invested in equity? Yeah, in shares. Okay. Right. So there are two types of investments. Mainly two types of investments. Can you all see the board?
No, sir.
Can't see.
Can't see.
Okay. Why? Is it shining or what?
No, it's not a clear. It's not getting a clear picture.
Ah, okay. Hold on. How about now?
Now it's good, sir.
Ah, okay. Wait, thanks.
Clear.
Right. So there are two main types of investments. You can either invest in the pen is pretty hopeless. You can invest in debt or in equity. Right. So what are the main differences between investing in these two types of investments, debt and equity? Yeah.
Obtaining a loan from a bank and investing in an asset.
Obtaining a loan from a bank and investing in an asset. Okay. What is that?
Debt.
That's called debt. Yeah, you're right. So debt are loans. So what are the main differences between debt and equity? Now this is something you may have studied in grade 2. The differences between debt and equity. Right? Just to refresh what you learned in grade 2. Huh?
Equity, you invest your own funds into shares.
Equity investment?
Your own funds into shares.
Okay. Right. The first point that you mentioned is quite interesting. You said you take a loan and then you invest in an asset, right? Isn't it?
Yes. Yes.
Yeah, good. It's good. A good point that you brought up. It's called leverage, right? Leverage. So what is leverage? Now that you brought it up, it's what you explained. You define leverage. You don't have your own money. So what you do is you borrow and invest in an asset, right? Now this asset can be anything. You can borrow and invest maybe in bonds, or in stocks, or in land, any type of asset. It's just that you need to borrow. You are not using your own money. You are using borrowed money also to invest, right? Now, I'll explain using an example. Can I quickly explain this, or do you want me to stick just to the topic? Do you mind if I explain?
Yes.
Okay. Right. So leverage is, now let's say, for example, you have $100 of your own money. Own money, $100, right? This is your own money, which you invest, let's say in a fixed deposit at 10%. So after 1 year, how much do you get? After 1 year, you will get
110.
Yes, interest of 10, correct? So this 100 can be 100 million or whatever you want, 100 billion, any amount. So let's just say 100. Now you're not, let's say you're not happy with the return of 10. So what you do is you borrow, maybe from a bank. You borrow 1,000, right? So 100 is your own. You borrow 1,000 and you put it in the same investment at 10%. You put this money in the same investment at 10%. How much do you get?
$100.
Interest of 100. This is interest. Now, if you borrowed, you'll have to pay interest now. Let's assume you borrowed at 8%. Huh? So the total interest you get now is 110, isn't it? You have your own funds of 100, you get 10, you borrowed and you get 100. So a total of 110. Let's say you're paying interest at 8%. Right? Interest at 8%. So what is your interest cost?
$80.
Is 80. Yeah?
Yeah.
Right. So you'll be left with 30. Clear up to now? Any questions? Correct now?
So how do we derive the 80 figure?
80. Well, you borrowed, no? You borrowed $1,000, right?
Yeah.
This is a borrowing
Yes.
which was at 8%.
Right.
Right. So after 1 year on 1,000, you have to pay interest of 80.
All right. Okay.
Okay. So you get a total of 110 minus the 80, you are left with 30. Clear? Right? Are we clear?
Clear.
Yeah. Okay. So now, if not for this borrowing, if this wasn't there, you will only have 10. But now you have 30. Yeah. But you end up with 30 with an overall investment of how much? Your investment is, you invested only 100, no? But your equity is only 100. Your return on equity is 30%. Eh? You end up with a 30% return. Instead of a 10% return, you end up with a 30% return. Isn't it? Clear? Not clear? Hello? Is that clear? See, you get a profit of 30 and your investment, your equity infusion is only 100. So you make a 30% return. Right? But if it wasn't for this borrowing, you would have only made a 10% return. Correct? Understood?
So this is here, of course, his investment is not 1,100, only the 100.
No, his equity is 100, right? And his borrowing is 1,000. So after 1 year, he gets 110. Now after 1 year, he gets his capital back. No? So he repays the 1,000 and he's left with the 100. Right?
Yes.
You can settle the capital in 1 year. Your capital is left. You can settle the borrowing in 1 year and your capital is left. Your equity is left. Isn't it? Right?
Yeah.
This is borrowed money, you can settle it. So it goes off. On 100, you make a 30% return, correct?
Correct, sir.
Yeah. So instead of ending up with 10%, now you end up with 30%. That's good or bad?
Good, sir.
That is very good. Right. My question is, when is leverage going to become bad? Under what circumstances will leverage be bad?
When the borrowing rate is higher than the investment rate.
Correct.
Before going
Yes, when the borrowing rate is higher than the investment rate.
Yeah, then the borrowing rate is higher than the return on investment, right? So what if your borrowing cost is 12? You will be spending 120 on your borrowing, and you will end up with negative 10, right? Then after 1 year, you can settle your loan. You will be left with 100. Which means you end up with a return of minus 10%. Clear? Right. So for as long as the borrowing cost is less than investment return, then leverage is favorable. Okay, are we clear on this? But if it's the other way around, if the borrowing cost is more than investment return, leverage is detriment. Okay, so that's leverage. Is that clear? So this can get tested at the exam. Huh? Yeah, any questions? No questions? Fine. Right. So the differences between debt and equity. What are the differences between debt and equity? What we just discussed is also an example, a difference. Debt is leverage. Debt leads to leverage. Equity, there is no leverage. Meaning, if you borrow using debt, your return always has to be more than the cost. Otherwise, you will lose. Okay. What else? Does debt mean ownership? If you have invested in debentures, for example. Debentures means, let's say you invest in debentures of John Keels. Does that mean you own John Keels? Let's say John Keels issued 1 billion rupees of debentures and you purchase the entire 1 billion. If you do that, do you own John Keels? If you buy the 100% of John Keels debentures, do you own John Keels?
No.
No. You own 0%. So debt does not give ownership. But if you buy 100% of the equity capital of John Keels, equity share, all shares of John Keels, then would you own John Keels? If you buy all the shares of John Keels, or even if you buy one share of John Keels, do you own John Keels? Yes. What else? What is the return debt holders get? Or with the creditors get? What return do they get? What's it called? The return that is paid to creditors is called?
Interest.
Yeah, you pay interest. But for equity, you pay?
Profit share.
Yeah, it's called dividends. Right. So paying interest is compulsory or not? Paying interest?
Compulsory.
Yeah.
Compulsory. Compulsory.
It is a must. Whereas equity, is it a must that you pay dividends?
No.
Yeah. You can forego during a particular year. Right. So this is what you learned in grade 2. Anything else? Any other differences between debt and equity? Well, Thanedu, to answer your question, leverage enhances return on equity, right? For as long as the return is more than the cost. It's not necessarily the total return and return on equity. Right? It is a way of enhancing return on equity. Right, so the differences between debt and equity, what we learned in grade 2. Now, the real challenge is to figure out the absolute difference between debt and equity. Right, this is how a grade 3 student would think. I mean, you go from grade 2 to 3, graduate from grade 2 and go to grade 3. What is the additional thing you learn? Okay, equity is introduced by the owner of the promoter. Very good. Debt is borrowing. Yeah. That's correct. Now let me put it this way. Let's say, for example, Haley's owns Singer now. Right, so Haley's owns a certain majority percentage of Singer, right? So Haley's owns equity of Singer. Now, if Singer wants to borrow through debt, can Haley's give, and they are raising a debenture, right? So let's say Singer is raising a debenture. Can Haley's invest in the debenture also? Can Haley's invest in the debenture? In the Singer debenture? Can Haley's invest in the Singer debenture? If Singer is raising a debenture, can Haley's invest in this debenture? Okay, well, understood the question. Can Haley's, which owns Singer, invest in a Singer debenture? Right? Can Haley's invest in a Singer debenture? Because Haley's owns Singer. Yes, they can. The answer is right. Haley's can invest in a Singer debenture. And so now Haley's is the promoter and they're investing, they're giving debt also to Singer. So the promoter can invest either in equity or in debt. It's up to them. And my question is, that was in response to the question raised by Tusita. Equity is introduced by the owner and or the promoter, debt is a borrowing. The promoter themselves can also introduce debt, borrowing. My question is, what is the main difference between debt and equity? Little more, one step beyond what we have already discussed. Just one step beyond. The difference is, now when it comes to debt, obligations have to be settled regardless of the performance of the purpose for which it was borrowed. Right now, for example, let's say this debt was raised to invest in make a certain investment. Right? So they made a certain investment. Let's say John Keels makes an investment in well, let's say they put up a hotel. John Keels puts up a hotel. If it is debt funded, and suddenly there is Corona, and let's assume that there are no moratoriums. There is some issue with the hotel. Nobody comes to the hotel. It is a flop, right? If that happens, John Keels will still have to service their debt. They will have to pay interest to the rent lenders. They will have to pay the capital back when it matures. One thing we forget is debt will have a maturity. This equity, no maturity. There is no maturity for equity. Right. So when if the hotel is a failure, but still John Keels will have to continue to service the interest, whereas the capital also will have to be paid when it matures. But if it was funded through equity and the hotel was a failure, it's not compulsory that John Keels continues to pay dividends. They don't have to, and equity does not mature, so they can continue to hold the equity also. Right. That means if a project is funded through debt, the failure or the success of the project is then borne by the borrower. Right? So the project risk is by the borrower. Project risk is borne by the borrower. Whereas if it was equity funded, then the risk of the project is borne by the lender or the investor. Okay. So this is one of the main differences. Is that clear? Did you all understand that? Final point.
Can you repeat the final things project risk?
Well, if it's debt funded, it is borne by the borrower, and if it's equity funded, it is borne by the lender. Right? Because if it's debt funded, regardless of what happens to the project, the borrower has to continue to service the debt. But if it's equity funded, if the project is a failure, then the shareholders will take the burden. They will carry the burden. Shareholders will carry the burden. Clear? Is that clear?
Sir, can you just explain that where the debt is having maturity and the equity having no maturity?
Yeah, so debt is a loan. If you take a housing loan or a personal loan, there will be a maturity. No? the bank will say you will have to pay it in 10 years or 20 years or 5 years or whatever. Whereas if you buy shares of that bank, then the bank will not give a maturity date. There is no maturity. Equity does not mature. Only maturity is if the company buys back the share or if the company goes bankrupt. Other than those two instances, there is no maturity for equity. Clear? You understood?
Yes, sir.
Okay, right, fine. Right, so these are the differences between debt and equity. Yeah. And today we'll be covering equity, not in detail, but very briefly. So financing methods can either be indirect finance or direct finance. Indirect finance is where an institution stands between the lender and the borrower, right? So indirectly, you're funding a project through an intermediary. We get a loan from our bank or finance company to buy a car. So there'll be depositors who give money to the bank, and in turn, the borrower will take a loan from the bank. That's called indirect finance. Direct finance, borrowers sell securities directly to lenders in the financial markets, right? So that is where you go and find the borrower and the lender will meet, and they will discuss and invest. Direct finance provides financing for governments and corporates. So this is how funds flow through the financial system. Okay, in direct finance, lenders and borrowers will meet, and the lender will invest in the borrower, whereas a financial instrument is given away to the lender, right? And in indirect finance, there is an intermediary, a financial institutions, which receives funds from lenders and lends it out to borrowers, right? Financial markets are places where instruments are bought and sold. These markets enable both firms and individuals to find financing for their activities. Pretty obvious what we learned in grade 1, not even in grade 2. These markets promote economic efficiency. They ensure resources are available to those who put them to their best use. They keep transactions at transaction cost low. So financial markets help promote efficiencies in the economy. Now, rather than you going to find a willing lender or a borrower, the market does it for you. So you know exactly where to go and whom to contact. Right? Otherwise, you will be spending a lot of money and time trying to find a party who is willing to either borrow or lend, depending on what you want to do. Then transaction costs are kept minimum as a result. And financial markets will reward the most efficient companies. So the roles of financial markets, right? Now this is where financial markets, this is how they operate. It's nothing new, not rocket science. Savers will give deposits to banks, and banks in turn will lend it out to corporates, right? Okay, so that's the normal borrowing and lending, deposit and lending procedure. Then through financial markets, you can either buy shares in a company or you can invest in debt. Could be in companies, right? So debt can come either from companies or from governments. Right. Now, this is called a capital market. Yeah. This is a capital market. The box is a capital market, whereas through banks is called money market, usually. Two types of markets, capital markets and money markets. So capital market means long-term investment, where you can raise long-term capital. It's called capital markets. Money market is where you need to raise short-term borrowings through money markets, long-term through capital markets. Money markets refer to markets for securities with maturities of 1 year or less. Right? So this is what you need to remember. This slide is very important. You need to know the difference between money markets and capital markets. So remember, it's a matter of the time period. If you want short-term borrowing, if you have short-term borrowing requirements, you have to go to the money market. If your borrowing requirements are longer term, then you have to go to capital markets. Money markets refer to markets for securities with maturities of 1 year or less. Capital markets refer to markets for longer term debt securities and equity securities that have no specific maturity date. Right, so that's the difference between money markets and capital markets. Right. So primary markets and secondary markets. Now, we discussed, I think, last week also the difference between primary markets and secondary markets, right? So when you get married for the first time, then you trade in the primary markets. Now, after you get married for the second and third time, when you get married, then you're trading in secondary market. Right? So it's as simple as that. When a security is issued for the first time to the market, it is introduced to the primary market. Subsequent trading happens in the secondary market. Right? So first time introduction directly from the company to investors is through primary market. Subsequently, various investors get in the way and it trades in the secondary market. Anything after the primary market becomes secondary market. A primary market is one in which a borrower obtains funds from a lender by selling newly issued securities, right? Borrower obtains funds from the lender by issuing newly issued securities, like buying shares from an IPO. So these are newly issued securities issued for the first time to the market is called primary market. Secondary market, any subsequent trading happens in the secondary market. Are those where people can buy and sell existing securities. For example, buying John Keys, buying any share after the primary market, if it's not issued in the primary market, it's called secondary market transaction. Yeah, you have questions? Right, so financial assets versus real assets. Financial assets are usually intangible, right? Assets like treasury bills, bonds, shares. Those are called financial assets. Include securities, derivative contracts, and currencies. Real assets include real estate, equipment, commodities, and other physical assets. Right? The assets which you can actually touch and feel. Real estate, equipment, commodities, and physical assets. So what is a share? Shares or securities represent ownership of a company. Right. It represents ownership of a company. Ordinary share represents ownership of a company. So that's, as we discussed earlier, it represents ownership. Shares represent ownership. Share represents a claim on the company's assets and earnings. Okay, so remember, shareholders have a claim on the company's assets and earnings. Any residual earnings of a company and residual assets belong to shareholders. Right? If you all can remember what you learned in grade 2, the basic equation. Assets equals liabilities plus equity. which means equity is equal to assets minus liabilities, which are also called net assets. Okay. So net assets, in other words, are equity. So this is what belongs to shareholders. Anything that remains, any asset that remains after settling your liabilities belongs to shareholders. Likewise, any income that remains after selling, after all your expenses also belongs to shareholders, like the net profit. As you acquire more shares, your ownership stake in the company becomes greater, right? So, for example, if you had 10% stake in John Keel's, and subsequently you started buying John Keel's and increased your stake up to 50%, then you have a higher stake, a greater stake in the company, right? So, the benefits of acquiring a greater stake is your controlling power increases, right? Now, at an AGM, for example, if you are asked to vote, then you will your vote will represent 50% of the ownership of the company. Right, 50% of that is determined by your stake, by your vote. But if you only 1%, then your vote only counts up to 1% of the total votes. Whether you say shares, securities, equity, or shares, it all means the same thing. Holding a company shares means that you are one of the many owners of a company, right? If you own shares, you can be one of many owners. A share is represented by the share certificate. It used to be share certificates, but now everything has been automated, digitalized, so you don't get a share certificate anymore. This is a fancy piece of paper that is proof of your ownership. Today, those records are kept electronically, right? So everything is now on a digital platform. You can buy and sell shares on platforms, not on a piece of paper. Now, being a shareholder or owner, being a shareholder of a public company does not mean you have a say in day-to-day running of the business. Right? So although you own, let's say, 50% of John Keel's, you can't go daily to John Keel's and tell them that you want this and that done. It doesn't work like that. Right? Your only right is to vote at an AGM. Beyond that, the management of John Keel's will take the business and run according to their fancies. Instead, you get 1 vote per share to elect the board of directors at annual general meetings. At AGMs, you can elect directors using your vote. Other than that, you can't interfere with daily operations of a company, right? So if you buy shares, don't run to companies and tell them that you want things done in this way. Board of directors runs the company operations on behalf of shareholders. Right? So on behalf of shareholders, the board will run the company. So they have a stewardship function. The importance of being a shareholder is that you are entitled to a portion of the company's profits and have a claim on assets, which is what we discussed earlier. profits are sometimes paid out in the form of dividends, right? So shareholders, remember we mentioned that shareholders receive dividends. Your claim on assets is only relevant if a company goes bankrupt, right? So unless the company goes bankrupt, you can't claim your assets, meaning you can't sell your share, you can't get the shares, the shares will not mature unless the company is going bankrupt or unless you sell your shares. In case of liquidation, you receive what is left after all creditors have been paid. It's the equation that we discussed earlier, right? Equity is equal to all assets minus liabilities. By becoming an owner, you assume the risk of the company not being successful. Right? So remember, the risk of the project is with the investor if it is equity funded, right? Another extremely important feature of shares is its limited liability. Right? There is a veil of incorporation, meaning now if the company makes losses, if you are a shareholder, your maximum loss will be limited to the amount of your investment, right? So if you had invested 150 rupees to buy John Keys and all of a sudden John Keys goes bankrupt, your loss is going to be limited to 150. That's it. Nothing beyond that. As an owner of a share, you are not personally liable if the company is not able to pay its debt. So if they go bankrupt, you don't have to pay a cent more than the 150 rupees that you invested. Even if a company of which you are a shareholder goes bankrupt, you can never lose your personal assets. Right? So remember, if a company goes bankrupt, you will never lose your personal assets. Now, going back to the previous point, in the previous page, by becoming an owner, you assume the risk of the company not being successful. Right. Now, which one do you think is expensive? Debt capital is expensive, or is equity capital more expensive? What are your thoughts? Which is more expensive? What do you think is more expensive? Is it debt capital or equity capital? All right, Manik, debt is more expensive, okay? Equity. Right, so we have a toss-up between debt and equity. What do you think is the right answer? Which is more expensive, debt or equity? Equity is more expensive. Reason? There is a 50% chance of success, no? Either your answer is right or wrong. So you need to give just one of the two assets. Why do you say debt is expensive and why do you say equity is expensive? Equity return may not be certain, okay? What do you think? Why is debt? Why do you think debt is more expensive? Why do you say debt is more expensive and why do you say equity is more expensive? Reason? Right, so Sandamalika has given an answer, right? Debt specific interest, equity depends on profit, okay? Yeah, well, actually the reason lies here in this point. If it's debt funded, the project risk is borne by the borrower. Whereas if it is equity funded, the project risk is borne by the lender. Now, more the profit, more has to pay as return for equity, but it has an agreed rate. Okay, yeah. Right. Now, out of these two, who takes the higher risk? The creditor in this case, or the equity investor? Who is taking the higher risk of the project? Who is taking the higher risk of investment? The creditor or the equity owner? Yeah, investor takes the higher risk, isn't it? If you own equity, you take a higher risk. Why? Because if the project is a failure, then you must take the loss of the project. But here, if the project is a failure, you don't have to worry about the loss. It is taken by the equity holder. Right. Meaning, the equity holder takes a higher risk. So if he's taking a higher risk and his return is low, will he be happy, or will he feel happy about it? Will he want to invest in equity? Answer is no. If that is the case, then he will prefer to invest in debt. But he is investing in equity because he wants to get compensated for the higher risk that he takes. Right? He wants to get compensated for the higher risk. Understood? So if he wants to get a higher compensation for the higher risk, he will ask for a higher return, meaning the cost of equity should be more than the cost of debt. Clear? Understood? So equity capital can cost you more than debt capital. Any questions on that? No questions? Is that point clear? You all understood? Do you all understand why equity capital is more expensive than debt?
So can you explain it again? This little confusion.
Right, who takes the higher risk? Yeah,
Equity
takes the higher
hold.
risk, right? So if he is taking the higher risk, will he expect a higher return or lower return?
Higher return.
Higher return, meaning the cost of equity will be more than the cost of debt.
Cost of debt.
Yeah, because the return to the equity holder is the cost of equity, not to the company.
Yes.
Right. So cost of equity is more than cost of debt. Sachin is asking an interesting question. Are there limitations to debt capital over equity? Meaning the maximum debt to equity ratio? The line is not clear.
Sir, for debt capital, are there any limitations through legislators? And for share issues, are there any limitation.
Well, you have to get shareholder approval and all that.
Yes, sir. And from the regulators?
From regulators in certain industries, there may be
Yes.
with this capital adequacy ratios and all that.
Yes, sir.
But other than that, no real limitation
Okay.
for as long as you can manage it.
Okay. Okay, sir. Thank you, sir.
Okay, so any further questions? Right. Right. So on to share capital, what we discussed earlier. Share capital is the amount raised by issuing shares. Right. So it's the unit price of a share into the number of shares, which gives you the total share capital. In other words, the market capitalization. When a company is formed, legal documents state the authorized share capital of a company, right? So they will say what is the maximum number of shares that can be issued. For example, if it's 1 million shares that can be issued, the company, the authorized share capital of the company is 1 million. The company cannot issue more than 1 million unless they get shareholder approval. Okay. So authorized share capital is not supposed to be exceeded. Authorized versus issued share capital. Now, if a company had authorized share capital of 1 million, the maximum that can be in issue is also 1 million, but they can issue less if they want. Right? So maybe they might issue 750,000 initially, with the provision to issue the balance 250,000 later on if there is a need that may arise. So authorized shares are the total amount of ordinary shares that may be issued. The total amount of ordinary shares that may be issued are called authorized shares. When a company is formed, the legal documents state the authorized share capital of the company. Okay, so when a company is formed, with the company register, they should file these details, the authorized share capital of a company. Issued shares are the shares that have actually been issued. So you need to know the difference between authorized share capital and issued share capital. Nominal value of a share means the value of capital given for a share. So it might say the nominal value of a share of John Case is 10 rupees, but the actual price that is trading might be different, but it's called the nominal value. Right? So they might say they are issuing 1 billion rupees, 1 billion shares of 10 rupees each. So in that case, they are issuing 1 billion shares, nominal value is 10 rupees. Issues of shares by a company may be at nominal value or at a higher price. And so although the nominal value is 10, the share can actually be issued or traded at a higher price or lower price. If they are issued at the higher price, the difference is between this and the nominal value is known as the share premium. Right? So if the share is issued at 10, but it's trading at 100, then the premium is 90 rupees. Shall you try this example and give me the answer very quickly? Very simple example. So it says the company A has the following details. It has authorized shares of 10,000, meaning at any given point of time, what is the maximum number of shares that can be in issue? If authorized shares is 10,000, at any given point of time, what is the maximum number of shares that can be in issue? If authorized shares is 10,000, what does it mean? At any given point of time, what is the maximum number of shares that can be in issue? How much?
10,000?
10,000 is the maximum number of shares that can be issued. It can be less, but it cannot be more, right? And out of 10,000, they have issued 1,000 shares. Par value of a share is 10 rupees. Okay, so par value of a share is 10 rupees. Sam has purchased 100 shares. What is his ownership percentage? How do we calculate? So Sam has 100 shares out of what? Numerator is fine. What should be the denominator? Should it be 10,000 or 1,000? Should it be issued number of shares or authorized shares? Divided by
1,000.
divided by
1,000.
yeah 1,000. And he will have 10% ownership. Sam will have 10% ownership of this company, of company A. So it's the number of shares divided by the issued number of shares, which gives a 10% ownership. Clear? Any questions? Okay, are we clear? Can I move on? Let's try question number 2. So let's go through question number 2. It says X Limited has 250,000 authorized shares. It is issuing 100,000 shares at a nominal value of 10 each at 15. Right? So nominal value is 10. It's being issued at 15. You are required to state share capital and share premium collected. How much of share capital do you collect? Share capital is the nominal value into the number of shares, which is 100,000. And the share premium. Right. So the shares are trading at 15, nominal value is 10, means the share premium is 5 into the number of shares issued. Into the number of shares issued is 500,000. Clear? Any questions? Is that understood? So the current practice is there is nothing called nominal value. This is not considered. You do not account for the premium. You don't account for it separately. So the share capital is the issue price of 15 into the number of shares, which is 1.5 million. Right. So now you don't look at the share premium. Third question. X Limited is issuing 100,000 shares at 15 rupees each. You're required to state the share capital of the company. So the share capital is 15 rupees into 100,000 shares comes to 1.5 million. Right. So any questions up to now? Are we clear? Share capital versus equity. The next area. Okay, for those of you who got 1%, remember ownership is the number of shares you own divided by the issued number of shares, and not the authorized shares, it is issued shares. Issued number of shares. This is the ownership. Yeah. So it has to be 10%. Right, Lini, you want me to explain share premium again? Right. So the company might say actually that a share is worth 10 rupees. Right. So in an IPO, they will issue shares at 10 rupees. So the nominal price of a share, that means the price at which the share is first issued, will be at 10 rupees or might be 10 to 20 rupees. So whatever the company decides, that is the original price of the share when it is first issued. Now, when it is issued in the market, this price can keep changing. And now think of a car, maybe a Tesla, produced by Tesla. Right? Perhaps the price of this Tesla might be $100,000 when it is first issued in the market. But when it is subsequently traded, the price can either go up or come down. And so the nominal price of that car is $100,000, but later on the price can keep changing. Now, if the price increases, if it goes to $150,000 and the nominal price was $100,000, then the premium is $50,000. Or if it comes to $90,000 after some time, then this it's called a discount in that case. The discount at that point will be 10,000. Okay, so that's how the discount and premium works. Now, same thing happens to equity also. If a share was originally issued at 10 and later on the price drops to 8, the share will be trading at a discount of 2. But if it goes to 14, then the share will be trading at a premium of 4. right? So the original issue price is called the nominal price of a share. The subsequently trading price, the difference between subsequent trading price and the original price is called the share premium or discount. Right, Lini? Understood? Clear?
Yes, sir. Thank you very much.
Okay. Share capital versus equity. Equity means the owner's interest in the organization, like the equation that we did earlier. Remember, it's given here. Share capital is the first is a part of the equity. Share capital is part of equity, right? So basically, it means the owner's equity plus accumulated reserves. So equity is total assets minus total liabilities, right? This is the same equation that we derived earlier. So net assets is the amount of equity that you get. In the types of shares, you can have voting or non-voting. You also can have ordinary shares and preference shares, right? Ordinary shares and preference shares. Now, the difference between ordinary and preference shares is ordinary shares has what we call voting rights. Right? So ordinary shareholders can decide who is running the company, who is going to be on the board. All this decision making can be done by ordinary shareholders, whereas preference shareholders do not have voting rights. They can't vote. They're not allowed to vote. Ordinary shares, dividends is not guaranteed. It is not a must that a company pays dividends. But preference shares, if a company wishes, it can pay, but it still may not be guaranteed. It can be cumulative or can either be non-cumulative. So the types of shares, you have ordinary shares, which can be voting or non-voting, or preference shares, right? There are two types. Remember, ordinary shares have two types, voting and non-voting shares, right? Voting shares is called, now if you follow the market, it is .n. Preference share, non-voting shares are .x. So if you buy X shares, that means you can't vote. If you buy N, you can vote. Preference shares can be subdivided based on the basis of cumulative dividends. Cumulative dividends can be cumulative preference shares or non-cumulative preference shares. But cumulative preference shares means if you don't pay dividends in a particular year, then the next year you will have to pay double the dividend, right? That means your arrears keep accumulating. So if you don't pay in a particular year, the following year you have to pay double. Or if you don't pay for 2 years, the third year you will have to pay 3 times. Those are called cumulative preference shares. Non-cumulative means if you miss a particular year, you don't have to pay it subsequently. You don't have to pay double next year. Then on the basis of redemption are redeemable and irredeemable preference shares. So redeemable means there is a maturity date. Irredeemable, no maturity date. Ordinary voting shares, they are the virtual owners of the company, right? So voting shareholders are the owners of the company. They have voting rights and control the working of the company. There is no fixed rate of dividend. No fixed rate of dividend. Dividend is paid after dividend at a fixed rate is paid on preference shares. So remember, when it comes to dividend payments, preference shareholders will get preference. They will be paid dividends before ordinary shareholders. Right? Preference shareholders will be paid dividends before ordinary shareholders. And in the case of liquidation, also the same applies. Preference shareholders will be liquidated before ordinary shareholders. There is no fixed rate of dividends for ordinary shares. Dividend is paid after dividend at a fixed rate is paid on preference shares. At the time of liquidation, capital is paid after preference shares have been fully paid back in full. So liquidation, capital will be paid only if preference shares have been paid back in full. Otherwise, ordinary shareholders will not get liquidation proceeds. Ordinary shares are not redeemable. There is no maturity date for ordinary shares. Okay, Okay, so that was voting shares. Now we go to non-voting shares. They have all the features of ordinary shares except voting powers. They cannot vote, but they have the rest of the features, right? Meaning everything else that applies to ordinary shareholders applies to non-voting. Ordinary voting shareholders applies to non-voting shareholders except voting, right? So they get last preference in terms of liquidation or dividend payments. Yeah, the same points that we discussed earlier. There is no maturity. And preference shares are those shares which carry with them preferential rights for their holders. Right, so they have preferential rights in terms of liquid. When it comes to liquidation, preference shareholders will get preference. Dividend payments, preference shareholders will get preference. Then there is usually a fixed rate of dividend, right? So they will say 10 rupees a share every year dividend will be declared. Priority as to payment of dividend, right? So dividend will be paid on a priority basis. Preference as to repayment of capital during liquidation of the company. So if there is a liquidation happening, the repayment of capital will happen to preference shareholders before it is done to ordinary shareholders. Generally, preference shareholders do not have voting rights. Generally, they don't have voting rights. Types of preference shares. You could have cumulative preference shares, right? Like we discussed earlier. This means if dividends on a particular year is missed, it has to be accumulated and paid subsequently. That's called cumulative preference shares. These are those shares on which the dividend on a fixed rate goes on accumulating until it is paid in full. Non-cumulative preference shares, these are those shares on which the dividend does not accumulate. Then on the basis of redemption, redeemable preference shares, right? So redeemable preference shares will have a particular maturity date, right? So redeemable means maturing. So redeemable preference shares will have a maturity date. These are to be purchased back by the company after a certain period as per the terms of the issue. Irredeemable preference shares have no maturity date. These are not to be purchased back by the company during its lifetime. Right. So up to now, any questions? Any questions up to now? No questions? Meaning we can move on. And so no questions means either you understood everything or you have understood nothing. Okay, Sandamalika. Non-cumulative preference shares. Non-cumulating preference shares means, cumulative preference shares means if you miss, let's say a company has issued preference shares and they declare dividend of 10 rupees per share, right? Preference shares, 10 rupee per share dividend. Now, if it is cumulative preference shares, then on a particular year, if they cannot pay the 10 rupees, the second year they have to pay 20 rupees, right? They are accumulating for the 2 years, that including the one that they missed. So the dividend for the second year will be 20. Whereas non-cumulative means, by any chance, if they miss paying 1 year's dividends, they don't have to catch up during the second year. That doesn't have to happen. They can only pay just 1 year. No need to pay for the second year. I hope that's understood, Sandamani. No, if it's non-cumulative, there is no liability. There is no liability for previous dividends, only for the current year's dividends. All right. Any more questions? Any further questions? So how do you issue shares? Methods of issuing shares. There are various methods that can be adopted to issue shares. Meaning, if you're issuing shares for the first time, or if you're issuing additional shares, then targeting what kind of investors, right? So all these can be done in various ways. By the way, now last week, we saw S&P downgrading Sri Lanka's credit rating, isn't it? It was downgraded to CCC. So Sri Lanka downgraded to CCC. Yeah. Right, so credit ratings. There are two types. One is investment grade. The other one is non-investment grade. Investment grade, non-investment grade. So what are the investment grade classification? Now, who gives credit ratings? Who assigns credit ratings?
Fitch.
Yeah, by rating agencies, right? Like Fitch. What else? Only Fitch.
S&P.
S&P. And that's it. What about Moody's? Then locally we have ICRA, isn't it? Yeah. So last week, S&P downgraded Sri Lanka's credit rating from B minus. We were downgraded to CCC. Right. Now, there are two kinds of ratings: so investment grade, non-investment grade, or it is also called junk. The junk category. So, what are the investment grade ratings? Highest investment grade is what? Any idea what is the highest investment grade? Yeah, there is no AAA plus. The highest possible is AAA. So, good attempt. Then after AAA, what comes after AAA? What comes after AAA?
Yes.
Yeah. What comes after AAA? No, there is no AAA minus. Yes. AA plus. Then AA minus, right? Then you get A plus, A and A minus. triple B plus, triple B, and triple B minus. So all of these ratings are called what? These ratings are investment grade. What is the highest possible investment grade? Triple A. Lowest possible investment grade? Triple B minus. What about non-investment grade? What is the highest possible non-investment grade? It is double B plus, right? So non-investment grade rank below all the investment grade ratings, right? Double B plus, double B minus, B plus, B minus, triple C plus, triple C, and triple C minus. So highest possible non-investment grade is double B plus. And so this is how credit ratings work. And the lower you go, your rating gets worse, meaning your risk will what? Increase or reduce? Your credit risk or the default risk will, when you go downwards, your default risk will, pardon?
Increase.
Your default risk will increase, yes. Right? So when your default risk goes up, it's, for example, it's something like, say, John Keel's Holdings comes to get a 10 million loan for 10 years. Fixed rate, 10 years, 10 million, right? And I come to you all to get a 10-year loan fixed rate for 10 years. So the amount and the tenor are the same. So if you quote 8% for John Keel's, will you all quote me a higher rate or lower rate? Same amount, same tenor. So just the difference, only difference is one is for John Keel's, other one is for me. If you are quoting 8% for John Keel's, the rate that you quote me will be higher or lower? Will be a higher rate, right? That is because the risk that you perceive in me, the risk that I carry is perceived to be much higher. And to compensate for the bank to get compensation for that risk, you should charge me a higher rate, right? So that compensates for the credit risk, right? So getting back. Methods of issuing shares, offer for sale. This is where the company which is issuing shares will offer the shares to an issuing house, right? So they don't do it on their own. They will get something like an investment banker to come and play a role. Generally, a merchant bank will act as an issuing house. The shares bought over by the issuing house will be reissued to the general public. So initially, shares are issued to this issuing house or the merchant bank. Then it is subsequently sold by the issuing house to the public. So that's how offer for sale happens, right? It is offered for sale and the issuing bank or a issuing agent will buy it, right? Like a merchant bank. A merchant bank will purchase it and then subsequently sell it off to investors. Initial public offering. So this is something that all of us are familiar with. Initial public offering is an IPO, right? That is where shares are issued in the market for the very first time. It's like getting married for the first time. Initial public offering. So when a share is issued for the first time, it is a tedious process, right? It has to go through so many things and lots of paperwork to be done. You need to approach maybe investors with the prospectus, and once the investors are happy, you need to make sure that it is subscribed to a certain extent. Otherwise, it will be a flop. Initial public offer is where the company will directly issue shares to the general public by preparing a document called a prospectus. Okay, so it's very important that you remember this word, prospectus. It gives all the details about the company, the history about the company, the future potential of the company, the challenges that it may face. And now, if a share, the IPO price is fixed at 100 rupees, it will also explain what the rationale is. By the way, recently if I'm not mistaken, the largest IPO in the world was an IPO by Aramco, Saudi Aramco, right? I think Alipay was also planning an IPO which would have been much bigger, but it was put on hold. They had some issues and it had to be put on hold. So an initial public offer is where the company will directly issue shares to the general public by preparing a document called prospectus, which will be issued to invite the general public to participate in the share issue. Okay. So this is where the general public is invited to participate in the share issue. It's called an IPO, investing in a company through an IPO, initial public offer. The next one is called private placements. Now, instead of issuing to public, shares are issued only to a selected set of investors. This is where the company which is carrying out the share issue will select large institutional investors and offer the shares by conducting roadshows. Right? So the company will select large institutional investors. They don't want all retail customers to invest. They will want only a few big investors to come and pump money. That will be canvassed through roadshows. The roadshow is where the company will conduct a presentation to educate the selected investors about the share issue. Offer for sale by tender. This is where the company which is issuing shares will call upon the investors to bid the price at which they are willing to buy the shares. Right? It's like a normal tender process. So they will ask investors, they will announce to the public that they're going to tender their shares, and they will ask investors, potential investors, to come and submit their bids. Right? So what they will do is they will keep track of all the bids that have been submitted, and then the priority will be given, what do you think, to the highest bidder or the lowest bidder? It has to be to the highest bidder, right? That's how the company rakes in the maximum amount of capital. Yeah. So this is where the company which is issuing shares will call upon investors to bid the price at which they are willing to buy the shares. So investors will be asked to bid prices at which they are willing to buy. Therefore, each individual investor will indicate the quantity of shares they expect to buy and the price they are willing to pay. So what amount and what price they are willing to pay. Yeah. So remember, they need to indicate the amount and the price. The company should decide upon a price at which all the shares can be issued and collect the highest possible revenue. Yeah. So they need to know at what price all the shares can be issued, right? So that they will collect the maximum revenue. So the idea is to get the maximum possible revenue. And there will be a cutoff point, right? Now, let's say The first investor bids for 100 shares at 1,000 rupees. The second investor 200 shares at 500 rupees. Third investor 1,000 shares at 300 rupees. Right? And if a company is planning to issue okay, let's do an example. Say a company wants to issue 1,000 shares, right? So it calls for bids. A submits for 100 shares at $1,000. B will come in for 200 shares at $800. Then C will bid for 300 shares at 500. D might want 200 shares at 1,500. E might want 500 shares at 400. Okay. So these are the bids that have been received for the tender. Now, when the tender is called, the highest bidders will get priority. And that is where the maximum price comes in. Because they'll have 3 million coming from this. That will be given the highest priority. Second will be to this guy. Now, if you just calculate the number of shares, bids that have been received, 300, 600, 800, 1,300. At 1,300, they only need 1,000. So D will get priority, 200 shares in. Then A will get the second place, 100 shares at 1,000. It's not 3 million, it's 300,000. Hundred shares at 1,000 is 100,000. This is the third. 200 shares picked again at 800 is 160,000. Then the 300 shares will be picked and collected 150,000. And finally, now they have already collected 100, 300, 600, 800. Right? So out of the 500, they will pick 200 shares. Only 200 at 400, which gives 80,000. That's the total number of shares will be 1,000. Total amount collected is $790,000, which means share price will be 790,000 divided by 1,000. 790. Tarendu, you have a question. Triple C, one before the lowest grade. No, not really. It's not one before the lowest. Huh? After triple C, you have triple C minus, then you have double C plus, C minus, and then you get to D. D means you are good as dead. That means you have defaulted. Triple C means there is a high risk of default. but it doesn't mean default. Hope it is clear. You understood? Okay. Right. So this is issuing through a tender. Right. So it's offer for sale by tender. Then stock exchange introduction. This is where a company which already has shares will introduce itself to the stock market. This is where a company which already has shares in issue wants to obtain a listing in a recognized stock exchange, right? So that might be to pave way for existing shareholders to exit in that manner. In a stock exchange introduction, the company will not issue new shares. Remember, they will not issue new shares, but will obtain a facility to have existing shares traded in the stock exchange. So existing shares will be listed in exchange, not that they're going to issue new shares. Right. So categories of security markets. There can be two types of markets. One is order driven, other one is code driven. Right. Now, order driven means you give an order to a broker. You tell the broker that you want to sell John keys at the price of 160. Right. So you have given an order to the broker. So the broker needs to execute. You want to sell, let's say, 1,000 shares of John keys at a price of 160. So the broker has to execute your transaction at the price of 160 only. He will have to wait until the market hits 160. He can't do it anything below that. Right? But will John keys increase to 160 tomorrow? No one knows. Nobody knows. Will it go to 160 in 2 weeks? No one knows. 1 month, 1 year? No one knows. Right? So there is uncertainty in terms of execution. Whether it will get executed or not, nobody knows. But if it gets executed, it will get executed only at price of 160. Right? So in the case of execution, it will only happen at 160. So that's called order-driven markets. Then there is a market called code-driven market. Meaning, if you want to sell John keys, you go to the market and hit whatever the bids that are there, like code-driven. Yeah. So order-driven and code-driven. So if it's code-driven, then you actually don't know at what price it will get executed. You don't know. You have no clue. But you are sure that it will get executed. For as long as there are buy or sell orders, it will get executed if it's code-driven. Right? So order-driven and code-driven markets. Now, if you are in a hurry to execute your order, which one you will have to use, order-driven or code-driven? If you are in a hurry, if you want to exit the market or enter the market fast. Which type of order will you give? Will you give order-driven or code-driven? What will you use, order-driven markets or code-driven markets? Will you be driven by the order or code-driven? If you want to exit in a hurry, remember execution is certain in which one? In code-driven, right? So, meaning, if you're in a hurry to exit, then you'll have to use code-driven. But if you're price sensitive, then you'll have to wait for, you'll have to do a order-driven, you'll have to be order-driven. Order-driven markets is where order matching and trade pricing rules are used to match the orders of buyers and sellers. Exchange and automated trading systems are examples of order-driven markets. Code-driven markets, this is where investors trade with dealers that maintain inventories of securities, currencies, or contracts. Share market is a market of shares. It is a market like any other market, such as a grocery store. The share market is an established market where people can freely buy and sell shares issued by companies, right? So it has to have features of an efficient market. A share exchange is an exchange or an organized marketplace on which shares are bought or sold. share exchanges operate under strict rules, regulations, and guidelines. So these are some of the examples: CSE, New York Stock Exchange, London Stock Exchange, Tokyo Stock Exchange. Now, these are not the only examples, and there are some more, like the Singapore Exchange, the NYMEX and all that. NYMEX is given, sorry. Right? Share index or indices. Sri Lanka has two indices: the All Share Index, All Share Price Index, and S&P SL20. Share market indices, which are very commonly used to measure and track performance of various segments of the market. Example, All Share Price Index can track whether the market is moving up or down. So All Share Price Index includes shares of all counters that are listed on the stock exchange. So by tracking the All Share Index, you can track whether the market has overall gone up or has it come down. And it can also be used as a benchmark to see whether you're doing better than the market or worse than the market. An equity investor generally refers to buying and holding of shares of stocks on a stock market by individuals and firms in anticipation of income from dividends and capital gains, or both, as the value of the stock rises, right? So that's it in terms of equity. Yeah. Do you have any questions? Any questions, guys? Right, so if there are no questions, maybe we can wind up. Don't forget to watch those movies, those of you who have not watched. Right. Anything you want to clarify at the last minute? Okay, so today how are the questions formed? In this section, you might be asked to give differences between the features, or differentiate between the features of the various types of shares, like ordinary shares, the two types of ordinary shares, voting, non-voting, and types of preference shares in terms of redeemable, irredeemable, or cumulative, non-cumulative. Then the types of markets, if they might say, give a scenario where the investor is in a hurry to exit, right? Which kind of market should he give? Should he give a code-driven order or a order-driven? Should he be trading in a code-driven market or an order-driven market? Or if it's price-sensitive and he's not necessarily keen on exiting in a hurry, he has time, then what kind of market should he function in, right? Things like that. Not very difficult, very easy, just the basics. Okay, any other questions? Good question, Dinesh. Right, so if there are no further questions, we can wind up. Okay, so thank you very much. Have a safe week, and I will see you all next week.